Hello everyone, welcome to our channel Decode Indian Markets. Today I'm creating this video for the purpose of just knowledge sharing. You have probably heard the word hedging quite a lot on the internet uh, from many YouTubers and Instagram influencers. They have been talking about it, and uh, so what I decided is to create a video, to understand what exactly is hedging, why do we hedge, and how do we go about hedging. So let's so I have created a small presentation and we'll go to the practicals, and this is going to be a very high level thing just to understand what hedging is, because this word has been around the internet, around the social media, and not exactly, so we need to understand just the basic thing what hedging is, and we can go in detail later on. All right, let's start from the very basics and understand what hedging actually is. So, hedging is essentially a risk management strategy which is used to limit your losses in one investment by taking an opposite position in related asset. Okay, so we'll go into details. So what basically this means is you have invested in one particular instrument or one particular asset. So you are expecting that asset to go up, like you are expecting to make some profit out of it. But at the same time, you cannot control the market, you cannot control the system. So what you do is you take a other asset or other instrument, or there are different ways to hedge, so that you, if at all the situation does not go as per what you want, as per what you are expecting in the market or in the world, in that case you do not lose everything, or you do not lose a big chunk of your capital, your investment, right? That is what hedging is. Now there are many hedging techniques, but at this point, since we are dealing with the securities market here, we are talking about the stock market. This channel is about stock market. So hedging techniques, for the basic understanding, we can use futures and options, which is nothing but derivatives, equity derivatives, and then you have diversification. So we have here we can see there are three methods you can hedge. One is with futures, one is with options, and which are nothing but derivatives, and then one is diversification. Diversification in the sense, for example, you are not putting all your investment in one particular asset. For example, you can invest some amount in equity, right? A share market. You can buy some shares, and at the same time, you can buy gold as well, whether physical or commodity. So, commodities is one other class, asset class, and then you can go and buy some property, invest in the real estate. So that is what we call diversification. And futures and options we are going to discuss. So I'll go to the sensible and show you how we can invest in stock market and hedge our positions. So this will be very basic thing. Let's go there directly. Mm, Okay, so if you see here, it's all blank. So suppose we are at Nifty's running around 25,910. So we are actually expecting Nifty to go up, right? So it's been seen from the starting of the market that the market always goes up. Whether it can have some pullbacks, it can go down 10%, 5%, 2%. Depends on the world situation, market situations. So what people do is they hedge their positions in case they understand that we can have some adverse effect anytime, or there are some situations going on. For example, we have seen the tariff wars going on, which Trump tweets any day that he's applying tariffs on China, India, to all other countries. and then suddenly we see next day market opens 1% down, 2% down, and market crashes suddenly. So if we have some stocks in the market and we want to like secure our um, investment, we don't want to lose most of our investment. In that case, what we can do is we can hedge our positions. And how we can hedge our positions is using the futures and options in the stock market, right? So let's see. I'll show you one technique, one very basic thing which everybody does, so that we understand what hedging is. So let's assume that we are expecting Nifty to go up. Okay. So what I'll do is I'll buy futures of Nifty 25th November. Like 10 days remaining. I'll buy futures of Nifty at this level, or maybe I'll just buy December future 45 days, right? So I'm saying I'm buying it at 26,157, right? So if you see the payoff chart, if the market goes up, I'll have a profit, right? If the market goes up, I'll have a profit of how you can see. And on the expiry day, I'll be able to make 5% of my capital, and my capital margin used is 2.22 lakhs. And if I am going in the positive direction, I'll be making 6% profit. So it will increase, of course. So as it goes up, the more it goes up, I'll be having more profit. Now, what if it goes down? I'll be suffering more loss, more loss, more loss, right? Because the delta of future is 1. Okay. So when it moves up, we'll be having more profit. If it goes down, we'll be having less loss. So hedging is basically, so we are expecting market to go up, so we are expecting to make profit. But what if it stayed here, or if it goes down? This can also happen, right? So just to not suffer this much loss, see, if you see here, just moving. So right now 25,910 is the uh, strike price. So if the spot comes around 800, right? You see expiry day we are losing almost 12% of our capital, of our invested amount, right? So what we do is, what if we buy a put of the same strike around ATM? Okay. So in that case, what will happen is, see, we go to 800. So we were losing 12%, if you remember, right? Now it has come to 10%, and actually it will be low. So if you increase this price, if you buy around 26,000 and you come to 800, you're just losing 8%. Of course, your profit will be less going forward, a little less comparatively, because this put will lose its value if it goes up. But you will not suffer a very big loss, and you can actually adjust this put like whichever strike price according to your strategy. For example, what you can do is, you bought this future today and you are expecting that tomorrow for sure it has to go up. So you just leave it as it is, and the next day you come and buy a put. If it stays there, then you buy a put. Or if it is going up, then you don't buy a put. If you see, okay, it has slipped 100 points or 50 points, then you buy a put against it. So this is one hedging strategy. We can do this in options as well. So if you go and see option strategy, these are all. This is when you are saying market is bullish. So you can either do bull call spread and bull put spread. Bull call spread is a debit spread, and bull put spread is a credit spread. We can talk about it later in some other video. But let's see that bull call spread. Let's open in Builder and let's see how it is hedging. So basically your view is that the market will go up, so you'll make profit. So if you see, when you're going up, you're making profit, it's in green, and when you're going down, you are in loss, right? So this selling of this call option is making our loss limited. So if you do not have this, right, so you will be having loss of 9,000. But if you sell this as well, then you can only have loss of 5,000, 5,786. Your loss is reduced, right? See, 9,000 to 5,000. And if you increase this, decrease this strike price, for example 26,000, then you see only 3,000 loss. This is what is hedging. That's what I thought of talking about in this video. And of course, we can see the risk to reward ratio is 1.2. Probability of profit has increased. If you decrease this one a little bit more, right, then the probability of profit has increased because it has come closer. So all these things about the strategy, about the bull call spread, bull put spread, we can talk about it later. I just wanted to talk about the hedging part. So we will be discussing other things in later videos. Um, that's all for this video. Thanks for watching. Please like, share, subscribe, and let me know in the comment section if you are expecting any kind of videos. I'll be coming up with these kind of videos as well in near future. Yeah. Thank you.